Ah, that's better. So, why does all this matter? Well, for one, it's part of knowing and understanding a company's financial story. I'll get to that a little later. More immediately, though, knowing how information moves gives you a better understanding of what I like to call the ripple effect of transactions. The reality for most bookkeepers is, between reconciliations and the organization of your client, business transactions don't always come to you in a nice, tidy, chronological order. What this means is that one little additional or updated journal entry can ripple through the accounting cycle and have a big impact on the financial statements. Before we move on, let's pause here and get some advice from an expert.
So bookkeepers need to understand all the various financial statements that are produced for a business owner so that they can really explain those, but also understand the effects of the day-to-day transactions on those. As an example, if a client were to purchase inventory, that is going to show up on the balance sheet. Eventually, it shows up on the profit and loss statement because when they sell something, that inventory is costed and becomes cost of goods sold, and it shows up on the profit and loss statement. So if a client has purchased a widget for $100 and then they buy them for $150, then there's going to be a change in their cost of goods sold once they get to those $150 items, depending on the costing method they're using. So it's really important to understand that. There are adjustments that happen that will affect the profit and loss statement or the balance sheet. And of course, we saw before that they're all connected. So eventually that profit and loss statement is going to affect the balance sheet because it is going to go there once the net income is recorded there. So lots of different ways that these things are connected, and understanding the effect on them is important. There are times when adjustments have to be made or corrections have to be made, and maybe one financial or another has already been produced. It might need to be run again to make sure that they're the most up-to-date information for that business owner. Are there times when we make an adjustment and it only affects the profit and loss and I don't have to rerun the balance sheet? Absolutely. But we want to make sure that we really do understand what's happening and that those are corrected and the financial statements are up to date for whoever may have run those, to make sure that they are correct and providing the information that the client needs. But the important thing is to understand what shows up where and when, understanding the flow of the transactions, being able to look at the accounting entry that has resulted as a transaction is put into the system is really important, so that we can see the flow of those and we understand that accounting entry and where things are going to show up so that we can explain those to the owner. Again, they're looking to us for guidance and information. The more we know, the more confident we are with that, the better it's going to be for that business owner.